Hello everyone, thanks for checking out my video. Last week may have been a short trading week due to the Good Friday holiday, but it was packed with drama. Jerome Powell sent shockwaves through the market during midweek. Semiconductor stocks plunged after news of new US export restrictions to China. And how about Trump? Well, he lashed out at Jerome Powell again and also teased the stock market on possible trade deals with both Europe and China. All of this has sparked major volatility as US stocks were whiplashed and whipsawed all week, ultimately ending in the red. With Trump's unpredictable tariff announcements, the ongoing US-China trade war, and earnings seasons heating up, this kind of market turbulence and whipsaw movements are likely here to stay, at least for the next few weeks if not months. If you are investing or trading right now, you need to be mentally prepared for that. And without further ado, let's unpack some of the things that I have just mentioned. So last week, the stock market ended the holiday shortened trading week lower as tariffs continued to worry investors. All three major indexes closed the week lower as they gave back some of the previous week's big gains. It was an eventful and dramatic week as we saw President Trump lash out at Jerome Powell again, saying the Federal Reserve Chairman's termination cannot come fast enough. He also said that Powell has been too slow in cutting interest rates. Trump's comments came one day after Powell delivered a stark warning about the effect of Trump's sweeping tariffs on the economy. The Fed chairman basically spooked investors by saying Trump's tariff policies could drive up inflation in the near term and cause challenges for the central bank. As a result, the market tanked on that day. Meanwhile, Nvidia continued to drag down the broader market. The stock plunged nearly 7% on Wednesday after the company announced a massive $5.5 billion charge tied to US export restrictions on its H20 GPUs to China and other countries. The sell-off didn't stop there as its share price dropped another 2.9% on Thursday, bringing the two-day loss to almost 10%. But by the end of the week, the market sentiment shifted a little bit. In a classic Trump fashion, both surprising and not, he struck the stock market with a more optimistic note. Trump basically said that he expects trade deals to be reached with China and the European Union, adding that he would have very little problem striking a deal with Europe to reduce tariffs, as he claims that the US has something everyone wants. In the post-trading hours, streaming giant Netflix reported their quarterly financial results, which beat Wall Street's estimates. The company also issued a second quarter guidance that is above analyst expectations. As such, Netflix shares gained about 2% in extended trading hours last Thursday. Okay, looking ahead to the coming week, it's not just about tariffs. All eyes also will be on the earnings. As earnings season ramps up, investors will be watching closely to see how companies are holding up amid all the uncertainty. Prominent names that are reporting this week include Tesla, Google, Intel, IBM, Boeing, and Pepsi. In the recent earnings calls, many companies have pointed out that the current environment makes it tough to plan ahead, and I think we will likely hear more of that same tone in the week ahead. But as mentioned earlier, the good news is that Netflix has kicked off this crucial earnings season for the mega cap tech names on a strong note. So now the big question is, can the rest of the big tech deliver similar results over the next 2 weeks? Just to highlight, the recent market reaction for downward revisions of companies' forward guidance has been pretty harsh. Take Nike and FedEx for example. Both companies recently lowered their outlooks and signal a more cautious tone for the year ahead. As a result of that, their stock prices took a sharp hit. So, with a wave of earnings reports coming out these 2 weeks, investors might want to stay cautious if you are still not. Alright, let's now move over to the technical analysis segment. We had a death cross on SPY's chart last week, which means the 50 moving average has crossed below the 200 moving average. Though moving average is a lagging indicator, a death cross is still a bearish signal. But before you get all too nervous and worried, here's some comforting stats. Looking back over the 7 other death crosses since 2009, research has found that 1 month later, the S&P 500 was lower 4 times with a median decline of 0.9%. However, 3 months later, the index was higher 6 times with a median return of 5.9%. As we look 6 and 12 months later, the data points to an improving situation where the S&P 500 was higher 5 and 6 times respectively, with a median gains of more than 10%. This is the main reason why I always pick up shares during fearful and bearish times like this, because in the long run, the market tends to go up. Anyway, let's go back to the chart and look at the short-term trend. To be honest with you, I was expecting SPY to hit that gap area last week, but it didn't happen. SPY got rejected right at the 50% Fibonacci level. Remember, I always talk about this 50% Fibonacci level, how the main trend typically takes over at this level. As we all can see, the short-term main trend is down and the rejection at this level shows it all. In other words, if SPY wants to reverse the current downtrend, it needs to minimally close above this 50% Fibonacci level at around 547. Otherwise, things are still looking bearish. Just to add, going above the 50% Fibonacci level is only the first step to reversing this downtrend. For confirmation, we need SPY to punch above the critical 61.8 Fibonacci level at around 562. Alright, in terms of the downside, pay attention to the MACD. The bullish crossover that we had looks a little weak right now. If MACD starts to have a bearish crossover, then I think SPY could go below 500 again. That's a 5% drop from the current price level, which is quite a major thing for SPY. Okay, one last thing to add. Let's switch over to the monthly chart. Check out the MACD. We just had a bearish crossover. This only happened 4 times in the past 10 years. 3 out of that 4 times when the MACD had that bearish cross, the market has not bottomed. The only exception was during the COVID crash where the market recovered very quickly. Okay, moving on, let's check out Apple's chart. Unlike SPY, Apple managed to fill part of the gap before falling down. But just like SPY, the trend is still bearish for Apple. As you can see, Apple was also rejected by the pivotal 50% Fibonacci level at around 210. So what happened was last Monday, Apple opened above the 50% Fibonacci level, but sellers stepped in immediately, and the selling pressure was heavy, thus pushing the price down. That's obviously bearish. Similar to SPY, the MACD looks weak at the moment, and if it crosses back down, Apple could easily breach the 23.6 Fibonacci level at 188. But unless we have really negative news from Trump again, I don't think Apple will retest the recent low of 169 this week. The next big movement from Apple will likely come after they report their earnings, which is on 1st May. In terms of the upside, or rather for signs of reversal, it would be the same as SPY. Apple needs to close above the 50% Fibonacci level. Not just that, it needs to fill that gap entirely and not get rejected by the top end of the gap, which is around 221. If we can close above 221, it means Apple would have reclaimed the critical 61.8 Fibonacci level at around 219. Okay, I'm not gonna elaborate too much on the bullish thesis because the trend now is clearly bearish. Sorry, give me 30 seconds. If you have found my content useful during these uncertain times and would like to support the channel, you may consider signing up a Longbridge brokerage account using my referral link. I do get some referral fees if you do so. Its promotions are all on their website, so I won't take up your time by mentioning it here. You can check out the links in the description box below. Thank you. Alright, moving on, let's have a look at Tesla's chart. Well, Tesla is reporting their earnings this week, so I think we can expect fireworks on the chart. As you can see, typically, the post-earnings movement for Tesla's share price is pretty huge, except for the recent one in January, where the share price only moved by 3%. Anyway, the expected movement for this upcoming earnings is around 9.6%, either towards the up or downside. But I need to caveat that this is just a prediction, so do take it with a pinch of salt. But that said, given the current market sentiment and with so much uncertainty in the macro environment, I personally would expect a huge movement in the share price. It should be bigger than the recent 3%. I mean, look at the chart. Tesla has been going sideways for more than a month, and usually after a period of consolidation, the next movement tends to be huge. If we use that 9.6% as a gauge, it means Tesla could either break below the recent low of 217 or it could go into the 260s range. Then again, if you look at the chart closely, going to 260s range doesn't really mean much, because that is where the green zone is, which ranges from around 264 to 272. Tesla needs to close above this green zone for any potential sign of reversal of the current downtrend. From there, once again, watch that 50% Fibonacci level at around 291. That's a huge resistance level, and therefore a potential level for rejection. But if somehow Tesla can close above it, wow, then I would say we could easily see 300s again. However, do you think that will happen these 2 weeks? I think it's tough, but I could be wrong. Why I think it's difficult is not just because how Tesla and Elon Musk have been troubled by so many negative news recently. Technical wise, the chart lacks strength in my opinion. Apart from the death cross we had recently, the MACD seems to want to curl down. It actually held up quite well recently and had a reversal on 8 April when the MACD seemed to have a bearish cross. It basically curled back up in just one day. But I'm not sure if a bearish cross happens this time, can it reverse so quickly again? If it can't, I think this 210s range probably cannot hold anymore. We could see Tesla in the low 200s or sub 200s again. Moving over to Google's chart, I like how Google went up to that green zone that I drew many weeks ago and got rejected and then fell back down. I'm not sure about others, this is why I believe in technical analysis. Anyway, like I said in my past videos, this green zone, which used to be a support area, has now turned into a resistance zone. So for Google to reverse its downtrend, it needs to, at the very least, close above this green zone, which ranges from 160 to 162. But for stronger confirmation, you know the drill, it has to reclaim the pivotal 50% Fibonacci level at around 174, which is quite a distance away. I know Google is reporting earnings this week, and even if we have good results and forecasts from the company, given the current weak market sentiment, I believe any pop in the share price will see sellers stepping in, which means I think it's very tough to regain the 174 level this week. If Google earnings disappoint, then I think the share price can easily slide back to the 140s range. At 140s range, watch that MACD closely. If it starts to have a bearish cross, then I think the recent low of 140 will likely be breached. That's when we will have the rare occasion of seeing Google in the 130s range again. In the 130s range, the next support level is at 130, a low that was created in March 2024. Moving over to Meta, so in my last video I shared how Meta was leading the way to show how the other big tech stocks could move, and I believe that still stands. As you can see, Meta got rejected by key resistance levels, mainly the 200 moving average and the green zone. Right now we are just a whisker away from its recent low of 482. Come this week, if Meta breaks below 482, I do think there is a decent probability that we could see 450s range, as that is where the next support area is. Below 450s range, I'm not kidding you, the next target for the bears would be the gap area between 398 and 412. Anyway, Meta is only reporting its earnings next week, so I think it's quite unlikely the share price will make such drastic movement towards the downside before its earnings. Okay, on the other hand, if Meta can bounce off the recent low of around 482, that's a positive sign. But then again, we need Meta to close above that green zone for any chance of revival. This green zone is around 532 to 547. And if somehow and somewhat Meta can go above 580, that's very positive, because by doing so the share price would have gone above a double resistance level formed by the 38.2 Fibonacci level and the 200 moving average. Next up, Microsoft. Just like most of the stocks that I covered, Microsoft also hit some form of resistance as it attempted to climb up. And once again, the resistance is the 50% Fibonacci level. At this point, how can you don't believe in technical analysis? Anyway, by getting rejected at the 50% Fibonacci level has proven that the downtrend is not reversing yet. In fact, 4 straight red candlesticks with a MACD about to cross back down says a lot about how bearish the trend is for Microsoft right now. And if we have a bearish crossover on MACD this week, Microsoft will likely be back in the 350s range at least. From there, I wouldn't even be surprised if the share price goes near the recent low of 345. But on the other hand, if for certain reasons, for instance, good news from Trump's trade deals with the European Union or China, and the broader market starts to fly, then there is a high chance that Microsoft will fill that tiny gap between 381 and 384. That being said, for Microsoft to reverse the downtrend, I have said this many times, the share price needs to minimally reclaim the 50% Fibonacci level at around 396, which I think it's very tough. The share price needs solid catalysts from Trump or its earnings to reach that level. For your info, Microsoft will only report its earnings next week. Okay, last of all, let's check out Nvidia. For Nvidia, I have redrew the downtrend channel. If you have checked out my last few videos, you would have seen a narrower downtrend channel. But I have expanded a little wider given the range that Nvidia's share price is moving at. So as you can see, Nvidia has been stuck in this downtrend channel since January this year. Or if you want, you can also stretch it till November last year. But then in the recent 1 month, the share price got weaker and weaker as it had difficulty going to the top end of the channel. From the chart, you will be able to see that it moved towards the middle channel and then fell back down again. That's bearish. For the upcoming week, investors should stay cautious because Nvidia is floating near a strong psychological support at 100. Not just that, the MACD seems to want to cross back down again. If 100 breaks, MACD has a bearish crossover, Nvidia could drop to the bottom end of the channel, which is around sub-90s. When we reach that level, I wouldn't be surprised if the bears push it further down to test the recent low of 87. As we zoom out the chart, you will be able to see that if Nvidia falls out of the downtrend channel, the big gap will likely act as a magnet to pull the share price towards it. This gap area is between 68 and 74. On the other hand, as you should know by now that the market is very tariff news driven, so if we can get some positive news from Trump, or even better, good news specifically for semicon industry, then I think Nvidia could fill that gap down easily. This gap down is between 106 and 110. From there, I believe the momentum from the whatever good news will likely push Nvidia to near the top end of the channel, probably where the 50% Fibonacci level is at around 115. At this 115 level, or at max, at the top end of the channel, I would expect sellers to step in again. Moving over to the options trading section, 3 trades to update this week, which are all summarized on this page. The first trade to update is this cash secure put on Tesla with a strike price of $300. It was supposed to expire on 25th April, but as you can see, Tesla's current share price is so far away from the $300 strike price. So to avoid early assignment, I decided to roll the contract down and out. The new strike price is $295 and the new expiration date is 16 May. Let's see how this trade turns out in mid-May. The second trade to update is this cash secure put on Google with 135 strike price. The contract was sold on 15 April Tuesday and will expire on 23rd May. What happened on 15 April was that the Japanese regulator issued cease and desist order to Google for their anti-competitive practices. As a result, Google share prices dropped slightly more than the other big tech stocks on that day. And so I decided to step in to open this slightly bullish move because this kind of anti-monopoly news is not new to Google and other tech giants. And usually, the immediate reaction by the market is a little knee-jerk and overdone. I believe Google will eventually bounce back. But unfortunately, later in the week, Google was hit with another similar news, as a US federal judge ruled that the company has used classic monopoly building tactics to dominate the online advertising space, and Google stock fell again. As always, to be transparent, and I'm not gonna hide anything, the trade is currently sitting on a paper loss of about 28%. Am I worried? Nah, I'm not. If you had followed my recent videos, you would have known that I've seen my trade went down 1000%. So what's 28%, right? Anyway, even if Google continues to fall from this point and eventually closes below 135 on expiration date, I may not mind getting 100 Google shares at 135 per share. What could make me consider twice is only because I just got assigned 100 Google shares at 175 strike price not too long ago. If I were to take another assignment, my portfolio would be very heavy on Google. Alright, the last trade to update is this cash secure put on Nvidia that expired last Thursday, 17 April. The strike price was $90 and the contract was sold on 10 March. A quick recap, what happened on 10 March was a bloodbath. The market was selling off massively, with the tech giants losing over $750 billion in market cap in the worst day for Nasdaq since 2022. Typically, when the market is so oversold, a short-term technical rebound tends to happen soon. That was why I stepped in to sell a put on Nvidia, which is a bullish move. Well, the bounce did come, but shortly after, Nvidia's share price continued to fall again, and my $90 strike price was breached at one point in time. The trade was in the red, but I didn't manage to capture any screenshot. Anyway, it doesn't matter because later on Nvidia bounced back up again and it managed to close above the $90 strike price. As a result, the contract expired worthless and I got to pocket the full premium of $188 without having to close the position. Alright, some thoughts to wrap up the video. First of all, Wall Street has been on high alert ever since Trump first announced the idea of reciprocal tariffs, a proposal which he later put on hold. But right now, everyone is just waiting to see what's gonna happen with all these trade deals. With Trump flip-flopping his tariff policies every other day and week, the market is just as indecisive as it looks for a clear direction, which explains the wild swings and whipsaw movements we have seen in recent weeks. Okay, as earnings season gets ramped up, I want to highlight two major risks to corporate profits this year. The first and the most obvious one is the ongoing trade war. Just so you know, the consensus earnings estimates for the S&P 500 are currently projecting about 9% year-over-year growth this year and 14.3% growth in 2026. But let's be real, those numbers were forecasted before the trade war escalated, and they now look overly optimistic and inflated given the uncertainty we are facing. I wouldn't be surprised if we start seeing more companies revising their earnings guidance downward for the upcoming quarters, as Trump's unpredictable tariff policies are paralyzing corporate decision making and causing demand fluctuations. And as we have seen recently, when companies miss earnings or lower their forward guidance, even if it's due to this trade war that's beyond their control, the Wall Street doesn't care. The market punishes them anyway. In short, the Wall Street is ruthless. Okay, the second threat to corporate earnings is closely tied to the first. In fact, it's more of a byproduct of it, and that headwind is the Federal Reserve. So in Jerome Powell's recent speech, he made it very clear the Fed's primary focus or mandate is to keep inflation under control while also maintaining a healthy job market. But here's the problem. With tariffs potentially pushing inflation higher, the Fed is now unwilling and realistically unable to cut interest rates as aggressively or as soon as the market had expected earlier this year. And this high interest rate environment will be another pressure point for corporate earnings going forward. All in all, tariffs are going to remain as a major driver of market sentiment in the weeks or even months ahead. Whether we like it or not, we are going to get new headlines and policy shifts almost every other day, and that's going to keep the market on the edge. We are clearly in the period of heightened uncertainty as the progress on trade deals remains gloomy at the moment. I mean, even if you put aside China, so far we haven't seen any real breakthroughs with other key US trading partners like Mexico, Canada, Japan, UK, or the European Union. I believe there is one big question that's on everyone's mind. In 90 days from the day Trump paused his tariff plans, will we have real progress or will we still be in limbo? Honestly, if these trade negotiations don't make significant progress by the 90 days deadline, we could be looking at a very rough second half of 2025. Okay, I know it's difficult to invest with conviction right now as the uncertainty in trade policy and the broader economy is very real. And based on what we have seen, these market swings and whipsaw movements are not going away anytime soon. At least not until we get more clarity on tariffs and trade. I also know this might all sound a little doom and gloom, but I'm just laying out the reality of the current macro environment and the headwinds we are facing. This is the truth, not fear-mongering. But that said, if there is one thing that I have said time and time again, and I will say it again, it's this. Times like this, when fear dominates and consumes the market, are usually the best times to find real bargains in good companies. As always, I can't speak for you, but personally, I would rather buy stocks when others are fearful, not when everything looks perfect and the market is at all-time high. Just remember, opportunities are usually born in uncertainty, not in comfort. So, if you're feeling a little jittery about the stock market right now, I hope this gave you a different perspective and helped ease your mind. Alright, that's it for this video. If you found it useful, do give it a thumbs up and I will see you in the next one. Thank you very much.